Good afternoon. Thanks for joining us for a 10th maybe webinar that we've done as part of the EU exit um, programme for the East Midlands Growth Hub Cluster. This one is pretty much a bit of a departure from EU exit, to be honest, and we're focusing more on life beyond the transition period. So we're going to be talking about developing overseas markets and managing international partners. And as you see as we go through, there's very much a focus on emerging markets, which is a particular passion of mine. But not only that, they offer tremendous opportunity to UK exporters looking to expand their horizons beyond the EU. And if one positive comes from our departure from the EU is the fact that we're all going to have to upskill in terms of export procedures, and then perhaps those overseas markets don't look quite so daunting. But essentially, by means of agenda, I'm going to be looking at the top UK export markets to give it a little bit of context. So where have we been exporting to date? We're going to take a look at the emerging economies space, so kind of like a flip through history from 2000 to forecast for 2024. Obviously, some of the figures I'm going to share with you and some of these maps are pre-COVID. So obviously COVID is a global pandemic and no country has emerged unscathed. So there might be a certain amount of rejigging of figures in light of COVID, but there's no doubt that the emerging markets are the ones that offer the greatest growth moving forward. We'll talk a little bit about their common characteristics, and then we'll take a closer look at the top 12 of them, identifying, what are their top imports and other unique characteristics that you need to be aware of when you're choosing markets to export to. What are the opportunities that they pose for UK exporters, and importantly, how can we mitigate against the risk? So emerging markets are typically high reward but high risk. So how can you mitigate against those risks? And there's risks with everything. There's risks with domestic trade, there's risks with international trade, and you could say that some of the emerging developing markets are a little bit riskier, but for every risk there's a mitigation strategy. So we'll talk a little bit about that. We'll talk about keys to success in terms of, there's no secret that we have traded very comfortably with the EU, and that's probably because we're very closely aligned in terms of language and culture. But obviously when we go further afield, there are cultural differences that we need to be aware of, and that is that cultural awareness is a key to success, really. So we'll talk a little bit about that. Then we'll talk about routes to market, different advantages and drawbacks for those. And then really part of the purpose of this presentation today is around selecting and vetting partners in those overseas markets as a mechanism to quickly expand that brand recognition in a way that would be perhaps too costly and too time consuming to do in a direct capacity, if that makes sense. So that's the agenda. Anybody who's listened into some of these presentations in the past will know that I wasn't an advocate of Brexit. I have done much soul searching for the positives since the referendum result, and I think, as I just alluded to earlier, trading with our neighbouring 27 member states has been comfortable, and it may have made us a little bit complacent in our exporting efforts. You just have to look at this graph to see that outside of the US, which is actually our largest trading partner outside of the EU, 9 of the remaining 14 countries are either within the EU or EFTA. Now we're getting better at penetrating lesser developed economies. So in 2018, our exports to India rose by 19.3% to 8 billion. And for that same period, exports to Taiwan grew staggeringly by 40.8%. We've also seen increases in our exports to Nigeria, up to 2.7 billion. And our exports to Thailand increased to 17.8%. To just over 2 billion. So we are getting better at penetrating those lesser developed economies, but there's still so much work to do. And as I said earlier, those emerging economies offer huge opportunities for UK products and services. And companies, we can't be put off by perceptions of complexity and risk, because like I say, there's a risk mitigation strategy for everything. So I really like these graphics. They denote GDP growth per country and how it fluctuates over time. So if we look at year 2000, we see that Argentina and Paraguay were categorized as being low growth, as was the Democratic Republic of Congo. And the high growth markets were really the Russian Fed, the Sudan, which was experiencing 8.4% GDP growth, Ethiopia too, and China, obviously, which remains a contender for high growth all the way through to present day. But Kazakhstan as well, 9.8% GDP growth. So that's the picture as it was back in 2000, but we see how it shifts when we get to 2019. So fast forward to 2019, we see high growth is still China, but its GDP growth has dropped to 6.1%. But we're seeing other emerging markets like Mongolia, 6.5%, India chasing the tails of China. Myanmar is an interesting one. The country itself, obviously, at the moment is experiencing significant difficulties, and it's really quite harrowing to watch some of the scenes on the news each evening. But it's actually a country that, up until the recent coup, presented an excellent opportunity for UK services companies, because they need to invest some $60 billion in infrastructure between now and the next 10 years. So that presented a fantastic opportunity for UK architects, project managers, companies within the construction field. But obviously, due to the recent coup, that market is just too risky. And actually, it's had a pretty checkered past with the EU and the UK. It only recently, the last few years, emerged from 5 decades worth of sanctions. So, but it just gives you an indication of just how much money these countries need to spend to industrialize. And Myanmar was one of those ones that was definitely on that trajectory, and we'll see how things unfold over the coming months. But then, in terms of actually looking further afield at the forecast, now again, appreciate the entire globe's impacted by COVID, so figures do require some adjustment. But you see, Russian Fed that was back in high growth at the beginning of in year 2000, you see that that's categorized by low growth with just GDP growth of 1.8%. High growth markets now, Myanmar still features in terms of forecast, but obviously this was pre-coup. But Cambodia, Uzbekistan, Nigeria, Egypt, they're all markets that we see are going to experience high growth over the coming couple of years. Okay, so it's just interesting to see how the pattern shifts over the last 2 decades. In terms of the common characteristics, so there are things that are common to emerging markets, and perhaps one of the most common is their potential for high growth. So that potential requires a lot of investment capital, and that makes them attractive to foreign investors. So there's a lot of foreign direct investment goes on in these emerging markets now and moving forward. They're categorized typically by income that's low to mid-tier. So leaders of emerging markets, so leaders of those regimes, if you like, are often driven to undertake quite rapid change to a more industrialized economy in order to remain in power and develop their society. So industrialization and a movement from heavily dependent or industry countries heavily dependent on agriculture is where a number of regimes want to get to. So a movement from heavily dependent on agriculture to more of an industrialization model. Now this quite often rapid pace of growth leads to social change, obviously, and that can lead to higher levels of volatility. There are also, some of these markets are prone to natural disasters and external price shocks. Their domestic policy can be quite unstable and so on. And as I just alluded to earlier, those economies that are traditionally reliant on agriculture are especially vulnerable to disasters. So, for example, the earthquakes in Haiti, the tsunami in Thailand, droughts in Sudan, and so on. But that said, those disasters can pave the way for positive change, so that the significant commercial development in Thailand and a big shift to manufacturing and industry to reduce reliance on agriculture. So those natural disasters and periods of extreme pain can lead to development of the country on the longer term. Obviously, those markets are more susceptible to currency swings, so especially those involving the US dollar. And there's no doubt that they are vulnerable to commodity swings like with oil or food. And essentially this is because if you think about it, they lack the power to influence these movements, and they kind of remain at the mercy of the more developed economies and their trade policies. Now, some of these emerging markets are cottoning on to purchasing power, and there have been a number of trade blocs established over recent years, which obviously their collective power is greater than one country on its own. Industrialization strategies that some of these countries embark on can obviously lead to some sectors of the population suffering. So, you know, it's not uncommon to hear of farmers losing their land, and obviously that over time can lead to social unrest, rebellion, political instability, which then results in a further regime change, and then the whole thing starts again. What else? They can often suffer from insufficient labour and raw materials. High inflation is quite common, or deflation actually. And obviously their markets are somewhat unregulated when you compare them to Western society. So, you know, there is the risk of unsound monetary policies. But as I say, all of these factors, they mitigate risk for exporters, but they present opportunities as well. And with international trade, there's always a level of risk, but there's always a risk mitigation strategy that can be implemented to help alleviate that risk. Now, I've taken the top 12 growth markets to have a bit of a closer look. And for each, we've given the GDP growth in 2019, and then we've given the predicted GDP growth for 2024. Now, of course, again, these forecasts predate COVID, and none of us can be 100% sure right now what impact this crisis will have on global growth predictions. But I've included also UK exports to these countries as a monetary figure and a percentage of UK overall exports. And then I've listed the top 5 products that we export. And then along with that, I've introduced a couple of other indices, if you like, which are really, really important when you're embarking on export overseas. So I've included the Ease of Doing Business score. So that's compiled by the World Bank. And the higher rankings, so a low numerical value, indicate better, usually simpler regulations for businesses and stronger protections for things like intellectual property rights. So the framework that the World Bank has pulled together, it looks at procedures, it looks at time, cost, and minimum capital to open a new business in that country. It looks at how the country deals with construction permits, access to credit, information and regulations around protecting investors. It looks at tax liabilities, trading across borders, enforcing contracts, and resolving insolvency. So a pretty thorough analysis to provide a benchmark. Now, the UK has a score of 8, so is deemed to have an incredibly easy business environment. So that gives you a bit of a benchmark on which to go on. And then I've also included the Corruption Perceptions Index. Now, this is compiled by Transparency International, and it's become the leading global indicator of public sector corruption. So the index offers an annual snapshot of the relative degree of corruption by ranking countries and territories from all over the globe. So what we've got here is the 2019 CPI, and that essentially draws from some 13 surveys and assessments done by experts to measure public sector corruption. The total number of countries, I think, is 180. And then each country is given a score from 0, being highly corrupt, to 100 being very clean. Now, again, for benchmarking purposes, the UK ranks 12th out of 180 and has an overall score of 77 out of 100. But just looking at the top 3 that I've given here, we see GDP growth in the 7% plus, but yet our exports are really low to those countries. So Ethiopia's main trading partners are China, the United States, Somalia, Kuwait, Switzerland also, and Saudi. now operates a trade deficit on goods of almost 12 billion, but the country has a wide range of duty rates from 0 to 35%, which is really quite high, and an average rate of duty of 17%. So it can put off exporters, because obviously with those rates of duty, their products in that domestic market are not going to be particularly competitive when compared to local providers. But in recent years, we have seen customs duties drop on a wide range of imports, but they are still just a little bit too high for some items. So vehicles, there's a really high rate of duty there. Now, Rwanda has a trade deficit on goods of approximately $1.4 billion. And that country actually continues to make really bold and ambitious steps to improving its business environment. So ranking 2nd position in Africa, and 38th overall for ease of doing business. So some great leaps made there. With regard to Bangladesh, really quite sad, because corruption continues to be a problem. And the country routinely finds itself amongst the most corrupt countries in the world. Now, they launched the Anti-Corruption Commission in 2004, but it's been deemed to be pretty much ineffective because of the level of government control over it. So it's the 54th largest export economy in the world, obviously, as we know, driven by a booming textiles and clothing industry, but it's just perceived to be too risky on the level of, for exporters, given the level of corruption that's inherent within the country. Looking at the next group of 3, so as I said earlier, our exports to India have risen sharply in recent years. But India's main trading partners are China, the US, UAE and Saudi. Now, the government's chomping at the bit. It's chomping at the heels of China in terms of its ranking on the global trade stage. So if you think about it, China accounts for some 17% of global trade and India some 2.6%. But the government really aspires and is making good headway to increase that figure to somewhere between 8 and 10%. Computers, plastics, medical apparatus and organic chemicals feature in its top 10 imports. Now, the Ivory Coast, 2nd largest economy in West Africa, is a top exporter of cocoa and cashews, but the country's economy is incredibly dependent on agriculture, and possibly as a result of that, its economic climate's perceived to be just quite fragile because of that dependency on agriculture. In terms of its top imports, we see crude petroleum, rice, non-fillet frozen fish, packaged medicaments and refined petroleum. Cambodia, really interesting one. So as a member of the ASEAN trading bloc that I am a huge advocate of, it's strategically positioned within Southeast Asia. So it has a major port on the Gulf of Thailand, and it also shares land borders with Thailand, Laos and Vietnam. And I think all of that, coupled with the fact that the business language is English, make it a really interesting country for UK exporters. I'm a linguist by trade, so I hate the fact that I go on about, English as being the business language, so that's a plus. But being practical and being realistic, it is. The fact that business language is English makes it an interesting market for us. And then the next set, so Myanmar we've spoken about, so recently emerged from those 5 decades of trade sanctions, only to possibly face some more. So we've got no trading history for that country, but like I say, $60 billion of investment in transport infrastructure between now and 2030. Tremendous opportunity. It's absolutely, devastating what the country's going through at the minute and the impact that it has on its industrialization and being able to, develop further for the good of its citizens. Laos, another interesting one. Its most important trading partners are China, Thailand and Vietnam, as you would expect, given the proximity. The country's operated a trade deficit for many, many years, but it's slowly reducing. It's growing its exports slowly. And it's recently completed a number of infrastructure projects which have helped further in terms of its development. It does have significant restrictions on the import of certain chemical products, weapons and types of medication. But But its membership of the WTO that it joined in 2013 has been really largely responsible for partial and in some cases total opening of all sectors to international trade, which is great. So they're more welcoming of international imports. Vietnam, probably one of the most open economies to international trade in Asia. Its main partners remain the US, Japan, China, and South Korea. But incredibly open to other countries looking to export to it. It operates a small trade surplus on goods of around 16 billion. It ranks above several of its Southeast Asian neighbours in terms of its regulatory environment for business, but it does remain dogged by corruption. So its current president was recently quoted as saying that anti-corruption efforts remain a major focus for his government throughout 2020 and 2021, and that the country will see a ramping of disciplinary and court action to tackle the problem, but it does remain dogged by that corruption side of things. And then the last three, so Tanzania, 9th largest economy in sub-Saharan Africa. It's a free market economy. It has good political stability, and its ease of doing business score is not so great, in so much as it's not long introduced several reforms and issues relating several reforms, and it I suppose it's as those reforms bed in, it's impacting its ease of doing business score, but that should improve over time as the benefits of those reforms start to filter through. Now, the Philippines is a really interesting one, particularly for B2C sales, B2C exports from the UK. It has a really strong consumer market. So its population and economy are growing, and it also has a large number of foreign workers. Now, all of these factors combined drive a really strong consumer market. A real appetite for luxury items. They have a real appetite for luxury items from international brands. They have an appetite for real estate, and service consumption is growing annually. And then Senegal. So although the average Senegalese consumer has limited purchasing power, the country has seen a tremendous emergence of an upper middle class with a high purchasing power. So that's opened up the market to a number of supermarket chains, mostly international ones. And Senegalese women in particular are huge consumers of beauty and skincare products. And again, attracted by international brands because they denote quality. And yeah, so there's, albeit the average consumer has limited purchasing power, there is, as we're seeing across these emerging markets, this emergence of this middle class with this high level of disposable income. So what opportunities do they pose? Well, if you think about the demographics, so a young population, emerging markets are denoted by a young population. So if you think about developing countries like the UK and the EU, we have aging populations. So, those aging populations are accelerating. So the baby boomers are retiring and purchasing power contracts. But in those emerging markets where the median age in some of them is 30 years or less, implies a larger workforce, higher consumption, and higher levels of disposable income. Now, the middle class, as I said earlier, is experiencing significant growth. It's probably one of the biggest trends of the Asian continent, to be honest, with China and India at the helm. And that middle class consumer is really the key driver of global demand. Now, we also see opportunities for education as well. So education is improving across those emerging markets. So we're seeing a rise in adult literacy. And the improved education provision obviously contributes to rising incomes because it enhances employment opportunities and leads to increased purchasing power overall. But there's huge opportunities for UK-based education and skills companies to export their services into those markets. We see digital technologies, obviously they have the capacity to unlock emerging economies, and we've seen leapfrogging in these markets. We've seen landline technologies bypassed and next generation of mobile phones massively adopted. And actually that's quite significant in terms of a couple of the slides that we look at in a bit. Their adoption of mobile technology is significant, and so much stuff is done via mobile devices. I spent a week in Singapore with a client a year or so back, and I don't think anybody consulted a laptop in the whole time we were there. Everything was done by their mobile device. The other thing, as I said, linking back to my comments about Myanmar, these markets require significant infrastructure investment, which obviously opens up opportunities for UK companies that are able to deliver large-scale infrastructure projects. And as I said earlier, significant opportunities for educators and companies offering vocational training, because that level of unskilled labour is still high in some of those markets. Okay, so significant opportunities if you're willing to just, be bold and get out there. So in terms of mitigating the risk, it's really awareness is the first thing. So it's, as I've said, I think it was 2 weeks ago when we did the mitigating risk and getting paid. It's around understanding what the risks are associated with that market. So research, plan. Be aware of corruption, and obviously that corruption perception index gives us an indication, but there's further research that needs to go into that. You need to be aware that the UK Bribery Act that came into law in 2010, it has extraterritorial reach for UK companies operating abroad. So that means that you can be deemed to have committed an offence if an employee or a subsidiary or an agent or a service provider, any what we call associated persons, bribes another person anywhere in the world to obtain or retain business or a business advantage. So we need to be aware of that extraterritorial reach of the UK Bribery Act. Obviously, getting paid is a consideration in emerging markets, and you'll definitely want to look at payment in advance, at least for the first few shipments. If it's not possible, you could explore letters of credit, bank guarantees, invoice financing with the likes of UK Export Finance or BB Financial, and obviously we covered methods of payment and mitigating risk during the last session. So we will get that uploaded to YouTube, and you will be able to access that. IP as well is something you need to be aware of. So protecting and managing that IP can be complex, particularly in these markets. So, we'd always advocate that you speak to an IP lawyer or another IP professional or advisor. And then I suppose depending on your budget and the countries that you're interested in, you'll need to decide, and again seek advice on this, whether to file separate IP applications in individual countries or make use of an international agreement that allows you to file in several countries through just that one single application. So IP as well, understand the cultural nuances. So, those first impressions can be made or broken with, getting it wrong, and we'll cover some of that in a bit. And that ties very much into understanding the way of doing business, that so much is tied up in that cultural awareness. And having an appreciation for the way that different markets conduct business and, their way of going about things. They might not move at the same pace as we do, but, you need that awareness, otherwise you're not going to get very far, really. Understand the political, legal and financial climate. So we touched on much of this a couple of weeks ago, doing that research to understand the levels of risk inherent within that market, both on the political and the legal and the regulatory side of things. Currency fluctuations, again, another big one. We've seen obviously the pound has fluctuated massively since the referendum result in 2016. International trade does have that level of risk that you won't see with the domestic market necessarily in terms of that currency fluctuation. So you need to have strategies in place to to manage that so that you're not hit hard by it, and then be aware of ability to trade. So those sanctions or controls that might be in place that actually prevent you from exporting to that market. And again, as we've covered in previous sessions, that's all in the commodity code, it's all in the tariff. Against your commodity code, you'll be able to see which countries you can import from and export to. Okay, so it's all about understanding the risk and putting strategies in to mitigate it. But in terms of the keys to success, so we kind of covered a little bit of this on the mitigating risk webinar, but I just thought I'd go over some of it. So export readiness, can't underestimate the importance of this, of understanding your company, taking that outside in view of your company and really asking yourself, are we in a position to export full stop, but then export to one of these markets? So what are your motivations for exporting? Is it to increase revenues? Is it to increase profit, spread risk, reduce your dependence on the domestic market? Is it just the timing's right for your product or your service? Branding, incredibly important in export readiness, especially with these emerging markets where we have, a gap in terms of cultural likeness or shared cultures. So does your branding translate? Can it cause offense? What needs to happen to your branding and your taglines and so on so that it translates well to that market? Is your product ready? Is it versatile? Can it be easily differentiated? Does it have potential compliance issues? So I always give this example of when I fell into export, as most of us do. Having left university with my undergraduate, I started working for Hammerite, so an ICI company, and we were hell bent on global domination. We were, we could export that paint to any market that we needed to. But actually, when it came to approaching the Russian Fed and the CIS markets, our formulation wouldn't work. It couldn't withstand the minus 30-degree temperatures that those markets were going to see. So we had to come up with a completely different formulation based on the unique characteristics of those markets. So understanding your product readiness and versatility is really important. Do you have the in-house skills? Do you have the in-house knowledge? Do you have the resource? If you don't, where are you going to get it from? Do your existing processes translate? Your competitiveness. So what's your domestic market performance like? Does it are the same things that are going to make you competitive in your domestic market, are they going to translate? So that kind of ties into unique selling points. So if your USPs in the UK are speed of delivery and lowest cost, they might not translate to export, because typically goods take longer to get to those export markets, and by the time you've added in all of the costs associated with getting to your landed cost, then you might not be the lowest cost when compared to other domestic producers or other international providers that are closer to that market in terms of geography. What's your capacity to fulfill that overseas demand? Have you got existing inventory? Can you recruit from other sources, for example? And then one of the most important, what's your financial situation like? Have you got the ability to invest in some of the upfront costs, to manage that cash flow, that sensitivity to exchange rate fluctuations, and so on? Export is very much a long game. Returns sometimes aren't as quick as in your domestic market, so it's not for the faint-hearted, and you need to have patience with it. But if you go about things the right way, plan, research, and focus on mitigating your risk, then it can be an absolutely thrilling ride. And no 2 days the same. It really is. I hope my passion comes across. I've been in export for 25 years now and absolutely adore it. Market research. So I'm skipping route to market because we're going to come on to that in a second, but market research, really important. Like I say, plan and research. What's the potential for your product or service in that target market? What's the GDP growth? What's the GDP per capita? What's the disposable income? They can all be things that can help indicate spending power. Is your product niche? or is it kind of run of the mill? How are you going to reach that market? So again, that ties into most appropriate routes, which we'll cover in a bit. What are your legal and regulatory requirements within the target market? So that in some cases can be probably one of the most challenging bits of market research, that regulatory framework. Obviously a lot easier to come by in the developed world where we have very documented regulations, but it can be a little bit challenging in those emerging markets. How big is the sector in the industry that your target market sits in? You know, is it buoyant? Is it stagnant? Is it mature? Is it emerging? And then tying back into previous slide, how stable is the market? Looking at that political and economic side of things. Are there any cultural considerations to selling in that market? And I can guarantee you with emerging markets, developing markets, there will be cultural considerations that you need to take into account. You need to know what they are and how you're gonna penetrate that market sensitively in a way that, you know, your brand is well received because you've understood those cultural considerations and you've accounted for those. What's the customer demographic? Are there similar characteristics to your domestic customers or completely different? What competition's present in that market? So who are the domestic competitors? Who are the local competitors? Who are the international competitors? Do you come up against those in any other markets that you're exporting to, or are they inherent within your domestic market as well in the UK? And then just practically speaking, obviously outside of COVID, are there any exhibitions or trade missions that you could take part in that allow you to kind of dip your toes, get a feel for the market before you decide, yes, this is for me. I should point out at this point as well, the Department of International Trade, they have the Internationalisation Fund that was launched back end of last year. So any trade shows, as and when they become available again, even those that aren't on the Trade Show Access Programme, would be eligible for that internationalisation funding. So it's something to be aware of. Pricing strategy, really important. Obviously, by the time you have added freight, insurance, duty, local taxes, your pricing is potentially impacted by all of those things. So what is your price to your customer going to be, and what is your margin at the other end, and do you have the margin that allows you to sell at that price in that country? And then social media, e-commerce and so on, we'll come on to in just a second. So social media platforms globally, I thought this was a really interesting slide. It's a little bit out of date, 25th of January last year, but it's the latest one I could get a hold of. This is the world's most used social media platforms, and most companies now accept that in terms of their marketing spend, social media advertising has to be in there somewhere. So how do you market your product locally? So even if you go down the indirect route and you appoint partners in those regions, do you embark on some marketing activity as well to kind of like feed their funnel, or do you you know, share some of the spend on that marketing activity? And if so, where do you invest that spending? So Facebook overwhelmingly still the major global player, YouTube quickly behind, and WhatsApp. I mean, WhatsApp is so widely used now, but then you will find regional variants as well. So China, everything is WeChat in terms of their social media. So it's interesting and it's important to understand which platforms are prevalent in the countries that you're breaking into. And there's I might have given the link at the back of these slides of where you can find that data and drill down into individual countries and regions and platforms. Social media use globally. So around the world, it really quite staggering figures here, which, you know, you're quite welcome to get a copy of these slides, so I won't read through them all. But you know, the one thing that I would pick up on was that total number of social media users accessing via mobile phones is really quite staggering. You know, we see it here in the UK, but it's replicated in those emerging markets as well. And then social media locally, I think it's quite interesting to take a look at that, because like I say, there are variations in the platforms according to the region or the country. So Facebook, I think looking at this, is number one with the exception of China, that has Pinterest. Now, China obviously has tighter controls in terms of content from overseas countries, so that may impact Facebook's prevalence in that respect. But no surprises with the UK, and quite similarly replicated elsewhere. So we see Instagram, Twitter, and so on. But you see how they vary in terms of, you know, first, second, third, fourth place. E-commerce globally. So, you know, e-commerce or selling direct through e-commerce can be quite an interesting way to test the market for your product. Obviously, we're very familiar with Amazon and eBay in the UK, but there are other e-commerce platforms throughout the world. So it's important that you understand where they are and how to access them. Because, you know, trying to sell on Amazon in some of these markets won't get you very far, but by registering your product on the go-to e-commerce platform could be the difference between your product shifting and your product not, if you like. This is this kind of ties into getting more into cultural awareness as well, but talking more about language here. So as a linguist, historically a linguist, I have this fantastic view of the world that everybody should try and speak one or two languages, but in reality that doesn't work. But this notion that you know, if you speak English it can get you everywhere actually isn't always the case, and actually you need more than 13 languages to address some 90% of the world's global online opportunities. So I've given the list of them here. So obviously English, you know, puts us in good stead, but there are other, obviously Spanish is a big one, and Chinese is a big one, to be able to cover that online community. And just some interesting stats here. So, you know, 72% of consumers spend most of their time on websites in their own language. So they may be able to speak another language, but they feel more comfortable, and obviously it's easier for them being on a website in their own language. And then 56% of consumers said the ability to obtain information in their own language is more important than price. That's a killer, really. So, you know, you could have the cheapest product on the market, but if you haven't adapted your offering and your marketing to make it that messaging easily to digest by your target consumer, then you're missing out on an opportunity. And obviously the only language that really matters is the language of your customer, which is so very, very true. Localization and not internationalization, bit of a strap line there, but very, very true. So market globally, sell locally. And just some more stats in terms of trying to dispel the myth that, you know, English is all we need to know, basically. So, you know, 70% of online search engines are not in English. Visitors stay twice as long if a website is in their own language. And I almost come out in hives when clients say to me, oh yeah, translation is not a problem, we've got Google Translate. It's like, no, it's not even about translation, it's about transcreation. When we're localizing our offering, a direct kind of word for word translation doesn't actually work. It's about taking the message and recreating it, transcreating it, with so translation and creation, transcreating it into something that does. So it references local colloquialisms. It sounds like it comes from a native tongue, and the only way you can do that is by deploying native speakers to do that. And some of our universities, particularly University of West England that I'm aware of, UWE, has some fantastic programs where they you know, offer placements for graduates and postgraduates, international students that can do some of this for you. You know, they can take your messaging, your tweets, your blogs, whatever, and transcreate them and push them out via the platforms that you're looking to use. So, you know, take advantage of that fantastic talent that we have access to via some of the universities. Cultural awareness, major key. So these are, you know, some of the ones that I'm aware of. So owl, so in the UK and actually in the US means wisdom, you know, the wise old owl. But in India it means stupidity, and probably even more damaging, in Saudi it means death. Okay, now moving on to the next one, lack of eye contact. So you'll know yourself, if somebody doesn't make eye contact with you, you immediately think they're a little bit shady, you're distrustful of them. But in Asia, it's respect. And, you know, I've experienced this many, many times, that you don't actually make eye contact, at least on those first few meetings. So it's a sign of respect in Asia, but a sign of distrust in the US and the UK. And then the number 7, so hugely lucky in the US apparently, but in Hong Kong, and I know not the reason why, but it has a sexual connotation. So, you know, if you're thinking of your brand name or your tagline containing the number 7, you might want to think about that for the Hong Kong market. And then red, so in the US, in Europe, it means love, it can mean danger, but in Africa it means death. So all of these, you know, when you're thinking about, does your brand translate, you're not just talking about the written word, you're talking about the colors, you're talking about the imagery. And, you know, there are some fantastic brand consultants, international brand consultants, that can help steer you on some of this. And it's probably money really quite well spent if you're serious about embarking on some of these farther flung territories where there is a gap between our cultures. And I just wanted to draw your attention to, you know, some of even the big boys can get it wrong. So these are some of the mistakes that have been made by big brands that invest millions in terms of launching in new markets. You know, KFC, finger licking good was translated as eat your fingers off, which is obviously not, you know, what they were trying to get across. Colgate launched the toothpaste in France named Coup without realizing that also it's the name of a French porno magazine. So, you know, even the big boys can get it wrong, and obviously they're investing significantly more money than you're going to be investing in penetrating those markets, but don't make the same mistakes that they have. Now, I just wanted to move on to routes to market. So just to really cover off some of these. So obviously direct, we know that can be via you know, digital forms, e-commerce, and, you know, your own international website, for example. And obviously we know that in Asia and the emerging markets, m-commerce and s-commerce, so mobile commerce and social commerce, are really big in Asia. But going back to say, with direct, obviously it has a number of advantages. It keeps you close to your customers in those markets, so you own that relationship, which, you know, can't be underestimated. You can have multiple channels to reach your customers directly. You can set your own prices to maximize profits because there's no third party involvement, so you're not having to give away margin to distributors or stockists or so on. But the disadvantages, obviously, the responsibility for the entire export process rests with you. So the marketing, the selling, the stock levels, shipping, everything. There's extensive amounts of paperwork to support a single sale through to completion. And then you've got the concerns around the after sales support and managing returns and so on. So it can also, with some of these markets where they're so far away from us, it can be difficult to work across different time zones when you don't have that local presence. So direct has advantages, but also disadvantages. Agents, and kind of touched on digital there with e-commerce and so on, but agents and independent reps. So obviously with an agent you get pretty extensive knowledge of that target market. They typically manage and control all local payments and documentation, and you obviously circumvent the recruitment, training and salary costs that you'd have using your own personnel to enter those export markets. Good agents are worth their weight in gold, and they'll be in a position to identify and take advantages of opportunities. They likely have established relationships with potential buyers, and having an agent on board means that you retain more control over the final price and brand image when compared to using a distributor, for example, where they'll take more ownership of that because they're buying the goods from you and selling them on, and you lose a lot of the control there. But the disadvantages, obviously the agent owns the customers and the route to market. If you fall out with the agent, it can be expensive to terminate that contract, because sometimes they may have a legal right to be compensated. Now, again, this can all be negotiated up front when you're appointing them. Selling through an agent leaves you still with that complexity of the after sales service, which you might not get using a distributor, for example. You might take on that after sales service. You'll probably lose a little bit of control over marketing and brand image when compared to entering the market yourself. And also they can be challenging to manage. I've had good experiences and bad experiences in my working career with agents. As I'm sure everybody has with every different route to market. Resellers and stockists, so the advantages there are obviously they'll buy the stock, they'll market it, they'll sell it, they'll support the product in their country or their territory. You can often find large multinational resellers or stockists, or some special independent companies. The products that you sell into them will typically be sold across all stores, whether that be bricks and mortar or online, or they might have regional launches, but then typically the plan is that the goods are kind of available throughout all of their outlets. It's not uncommon to find them with multiple stores in multiple countries, which is obviously an advantage. And they can have complementary products, particularly true of dealers, for example. So they may already be carrying other brands that complement yours. So there's a natural focus, which can be useful. Obviously, disadvantages, they're likely to demand a hefty discount. The marketing and pricing of your products is quite often out of your control. And I suppose another thing, I don't know the profile of everybody on the call today, but if we're all kind of micros and SMEs, you might be further down their list of priorities when compared to some of the larger brands. But that can be overcome. You can invest in sales training and marketing efforts so that your product filters higher up on their list of priorities. Distribution is probably the area that I've got more experience with over my time in exports. I've managed channel for a big part of my career. I've got a very positive view of distributors, but I think that's partly down to the fact that I've invested in that relationship with them, and it does really require that investment. If you're going to go down the distribution route, you need to be prepared to invest in that relationship. So obviously, in terms of advantages, you going down distribution, you appoint a distributor, you automatically have access to their networks, so their dealers and their resellers. They absorb a lot of the risk because they're typically purchasing the product from you, although there is the notion of consignment as well. Obviously, it negates the requirement for you to set up overseas, so saves you money. And you're only tracking one account or one relationship, whereas with stockists and resellers, you might find that you're managing quite easily, in the tens, the hundreds of them, and that becomes quite burdensome for a smaller company to maintain that level of relationship with each one of those entities. As a disadvantage, unless you're willing to invest in that relationship, you're unlikely to get the marketing and sales efforts for your products or even that your brand deserves, because they'll be concentrating on the top 5 to 10 selling lines that generate the majority of their income. So you really have to make some noise and invest in that relationship to filter further up in terms of their priorities. It could be said that the activities of the distributor are out of your control, so the marketing and the pricing depends on the relationship that you strike with them. Throughout my career, I've worked really closely. I've understood their business. They've understood the company that I was working for. We've invested in joint marketing campaigns. We've talked about pricing strategies. It's not fair to say that you lose control, because it's about how much, yes, if you're looking at black and white on your contract, you're not responsible for establishing a pricing strategy in that market, and they have the flexibility to. But it's about the relationship you strike and how much you invest in that. It's not uncommon to be asked to contribute financially to the marketing of your products, in addition to the discount that you're already giving them. And I would say that where we've seen particularly fruitful relationships with distributors are the ones where we've been willing to, you know, jointly invest in stuff in addition to what they're making from their margin. Just a quick one on contractual methods. So licensing obviously allows you to take a product to market without the expense of setting up locally, but the costs of registering all of the IP well in advance of any income, and making sure that the licensee will develop the market, and so on, that can be perceived as quite risky, and obviously those royalties are dependent on sales growth. So in terms of joint venture, so they enable us as UK companies to establish a presence in that overseas market, so we can capitalise on those opportunities without taking on the full responsibility and costs. But the disadvantage is obviously you don't have the direct control, and it can be difficult to monitor performance in an overseas market where, you know, they're so far away, and as I said, things like time differences and so on all have a role to play. So they're kind of like the standard routes to market and the pros and cons for each. I've just provided here, and again, anybody that wants a copy of the slides, quite welcome to them. Just for those of you that might not be that familiar with different routes to market and the things to expect of different partners. So I've kind of highlighted, I'm sure you all know what direct customers and consumers is, but then I've kind of highlighted what a distributor is and what versus a stockist and a retailer and then an agent, and how they're typically remunerated, and all that kind of stuff. So, you know, going through what we've talked about already, but I've put it into this supply quadrant. And then I've shared with you partner vetting and selection matrix. It's just something we have used extensively over years, and we just keep adding to it and taking stuff out. But when you're looking for partners in your export market, then, you know, that research and planning is as important as actually, you know, when you are researching the market and so on. It's important that you get to grips with who that company is. So there's a number of things that you can find out about them through desktop research, you know, through their online profile, but then there are other things that you can only find out through conversations with them. And then it's really subjective how you score them, but you will have a gut feel for the ones that are going to be more closely aligned to you and your brand and your company. And this kind of just gives a bit of a formal framework to that, if you like. So it includes some things that you might want to research in advance, but then also to be the focus of conversations that you have with these companies. And really you want to whittle down to no more than 3 or 4 top favourites to make your decisions on before deciding who to appoint. And then finally, just managing partners. So sharing, I suppose, a little bit of my experience over the years of what's worked well. So I can't underestimate that how fruitful that investing in the relationship can be. So when you've been able to forge those strong relationships, they've been essential, especially when companies that I've worked with, we've been you know, exporting to emerging markets where we've had those issues such as distance, time zones, language, and so on. We've really invested in that relationship and grown personal relationships out of it, not just business relationships, professional relationships. So if you think about those partners or that supplier or that distributor, they're your employees and they're your customers, so they need nurturing, and those personal relationships are everything. Quite often in some of these emerging markets, they have a different approach to business. We're very, in the UK, we're very staid, and we'll sit down to a business meeting. We might do an initial preamble, but then it's okay, let's get down to business. That's why we're here. That doesn't work in some of these emerging markets. They want to know about you. They want to know about your family. They want to know about your interests. They want that connection with you before they really sit down to discuss your product or your service. Obviously being really willing to share your vision, your practices, your resources, creates a link of trust and a desire on both parts to work towards mutual benefits. So it keeps partners interested, it keeps them focused. Obviously that investment in terms of your time and in terms of your capital can help partners to succeed. So you should really know what their business is like the back of your hand, to make a real impact on that trade relationship. Because if you invest, you garner their respect, you'll seem to be treating them differently to perhaps some of their other brands do, and they'll be sincere in wanting to help you reach your ultimate goals to properly penetrate that market for the brand. An insistence on getting regular feedback from end customers is really quite essential with the distribution side of things. So obviously that feedback from end customers, absolutely essential, because it can call out product or service issues that, if they're unaddressed, are going to cause damage to your brand, but also to your partner's reputation. So you need to instill on them the importance of that regular customer feedback. And again, essential to learn about the cultures and the traditions, to avoid being seen as being intrusive or overly dictatorial. Just by going about our business in our normal fashion can be misinterpreted if you don't know what the local norms and cultures are. In terms of partner management, so distributor management is really that constant monitoring of a partner without appearing to be, big brothers watching you, but it's been seen to be helping to optimize the sales process, so that both parties are motivated to put in more efforts to selling your product, and specifically selling your product over other brands that might be carried. So it's important that you understand market knowledge and benchmarking, so that you can judge any growth or decline in sales. As I've said, that development of a joint marketing strategy. What actions will the partner take to generate interest in the product? What actions will you take? What will be your contribution to your partner's actions? We have in the past invested significant amounts in product sales training. So, we invest the same amount in our distributors' employees as we would in our own employees back in our domestic market. Customize those sales arguments and those pricing and discount structures. So, take time to inform them of some of the strategies that are used in the domestic market, and help them adapt those for the market that they're selling into. Second line after sales support provision is quite key. So they might provide, first level, and then refer more complex queries and issues to you. Performance meetings and incentive schemes are key. So we used to have a couple of companies that I've worked with in the past, we'd have a president's club, and I appreciate that's just not doable for micro businesses and lower tier SMEs, but we'd have a president's club, and that was open up to some of our distributors as well, not just our own staff. And then that strategic partner management, understand how much of your time that warrants. So, 1 day per month at the beginning is not, the beginning of the relationship is not excessive. And then that can gradually be reduced to 1 day every 2 months for an established partner. But don't underestimate the investment that you need to make in terms of your time in order to make that relationship flourish and your product do well in that market. In terms of additional business developments, that continuous development in the relationship, where you've got multiple partners in a country, or maybe you've got a partner where your products are just actually a small part of their turnover, you can actually boost the demand for your products by doing some marketing or business development activity that helps feed their sales funnel, which is what I referred to earlier on. So scan the market for leads, for opportunities. If these become concrete, then hand them over to a partner or do a joint follow-up. Too often we see companies eager to, when they get an inbound lead, we'll deal with it because our margin will be greater, we're not passing it to the channel. That's absolutely the wrong way to go about it. It creates distrust and it damages the relationship. Where you've appointed a partner in that market, feed their funnel where at all possible. And if you don't trust them entirely, do a joint follow-up, like I say, but it enhances the relationship if you're seen to be giving them work in addition to expecting them to find their own. Look for options to profile them and their company, so that make join the two brands in terms of the customer's eyes. Take the lead on regulatory issues that might influence the sale. So it's your product that's going into that market. Obviously your distributor or your partner will or should be expected to feed into you with regulatory changes, but take the lead in terms of adapting your product and making sure that your product can still still fit. It's not the distributor's responsibility. And then, you know, I've got fond memories of many trade shows that I've attended with partners around the world, you know, where partners are organising events around your product, then offer to take part, offer to be on their stand, talk to their customers, offer to speak at some of their seminars. Anything that helps make you more sticky with that partner will over time equate to, you know, really profitable sales in that market. Oh my goodness, folks, I've gone well over again. So sources of additional information, again, a number of different URLs here. I think I have given the links to, yes, World Bank, Ease of Doing Business and so on. Yes, they're there. So yeah, that is basically it for me today. So very much a focus on export and a little bit more happy stuff rather than EU exit that we've been doing since September last year. As always, if there are any questions that you might have, please feel free to drop me an email. I can't see that we've got any in the chat or any in the QA. Let me just double check. No, nothing there. So if there's nothing else, obviously feel free to drop me an email if there's anything specific. But I hope at least my passion about these markets has come across, because they are so exciting. And you know, something good at some point has to come from EU exit, and you know, we do have to skill up. We're not this great exporting nation. We trade very well with our closest neighbours, but we do need to get our heads around export controls and so on. And then these markets don't look quite so daunting to us. So any way that the export department and the East Midlands Growth Hub clusters can help you with that, then we'd be absolutely delighted. So if that's everything, I will leave you to get on with the rest of your, I was going to say Wednesday afternoon, but we're still Tuesday. But thank you for your time, everyone, and see you in 2 weeks' time. Okay, thanks very much.